Hello everyone, welcome to our discussion of Chapter 4, Variance Analysis. We are hearkening back to what we've learned in Accounting 160, trying to understand how we apply budgets in terms of determining how we did after we have performed for an accounting period, and then compare that to the budget. So back in Managerial Accounting 1, we learned about the planning process, the reason why we create budgets, to have a vision, to know where our goals, where we're heading in our business. Okay, so, but to get better at that, we need to take that budget, that plan, and compare to what actually happened. Okay, and that may help us get better at planning. It also may identify our weaknesses so that we can improve and become a better company. All right. So part of the problem with that is a static budget only considers one level of sales production. So we planned to make 1,000 units, sell 1,000 units of product, but our sales were not what we planned. Does that mean that the rest of the budget is basically meaningless? Because if we're less than that in sales, we would expect to be less than that in expenses and costs, right? And so rather than just throwing out the budget, meaning, well, we didn't hit our goal in sales, so therefore we can't really use any of the other costs as part of our evaluation, we're going to introduce the idea of a flexible budget, one that can be adapted regardless of what our sales or production levels are. So to do that, we're going to need to adjust our budget to a concept of standard costs, and that's simply a budget per unit. So rather than looking at things in total, we're going to look at it per unit. So if we're making bicycles, then we need to figure out what our budget is, what our plan is for the costs of each of the processes that go into making that bicycle. All of the parts, all of the labor, all of the overhead things that go into that on a per unit basis. And then if we have that cost per unit, we can simply multiply by the number of units produced, and that's what our budget should have been. So now, whatever our units we produced ends up being, we simply multiply that by our cost per unit, and we have what we should have spent for that level of production, and we can compare that to what we actually spent. So if our static budget is 1,000 units and $50,000 in costs, then we're basically saying it should cost us $50 per unit. But if next month we only make 900 units, or obviously we would expect the cost to be lower than the 50,000, because that was for 1,000 units. But for 900, our cost should therefore be consistent and should be about $50 per unit. All right, and therefore would be 45,000 in total, and that's what we would use to compare to what actually happened, to see if we did better or worse than what we should have done to make 900, rather than comparing it back to the 1,000 or the 50,000, which doesn't make any sense because we didn't have that happen. Okay, so that simple example in the last slide just lumps all costs together, but to really understand how we did and where our strengths and weaknesses are, okay, we need to make it a little more complex. We need to break down our costs into some categories that we're already familiar with, that we've talked about in multiple ways, and that is direct materials, direct labor, overhead, both variable and fixed, so that we can make some comparisons from actual to to what we plan to really hone in on what it is that is causing our costs to be higher or lower than they should be. That also comes into play. We're going to think about, for overhead especially, the difference between variable costs, which are going to go up and down with volume, right? And fixed costs, which aren't. So when we approach budgets, we obviously, the idea of how we would budget for a variable cost versus how we would budget for a fixed cost is very different. Okay, so variable costs we're gonna be able to create the standard cost idea, and then just multiply by the units produced. Okay, so that's kind of our application to direct materials, direct labor, which are both variable costs, as well as the variable part of our overhead. But we won't quite use that same thing with fixed overhead. So how do we come up with what it takes to make one unit? How do we come up with these standard costs? Well, let's think about it. How much should it cost to make a batch of cookies, as an example? So we start with direct materials. Okay, what needs to go into, what ingredients do we need to add into our cookies to make a batch? Okay, so we would look at the recipe. Okay, one of the things might be in that recipe might be chocolate chips. So we look at what the recipe calls for, the amount of chocolate chips per batch. And then we take that and we multiply that per the cost per pound. What is it going to cost us to get chocolate chips? So the standard quantity, how much we are supposed to use on the recipe, standard cost, that's what we pay for the chocolate chips. So our recipe calls for 2 pounds of chocolate chips per batch, and we are thinking that it's going to cost us $4 per pound to purchase them. So our total standard cost for a batch of just chocolate chips would be $8 per batch. And of course we would do the same thing with flour, sugar, all the other ingredients, all the direct materials. Okay, we'll typically only do it with one direct material per product, but you can do it the same way for each direct material. So that gets us the idea of what we would be spending for a batch of cookies for ingredients. Moving to the labor that's needed to mix the cookie dough. Okay, so we need to figure out and look at how much time it takes to mix one batch of cookies, and then look at the cost per hour for those people who are mixing those cookies. So we look at the standard quantity, that's 20.25 or a quarter of an hour, 15 minutes if you like to think of it in terms of minutes, per batch, and it's $16 per hour for our labor folks. And so that's $4 of direct labor, actual mixing cost per batch of cookies. So we've got it to $8 of materials, $4 of labor, okay, or at least for one of the materials. Now, just to pause a little bit about how we set these standard costs, or how to utilize them, okay. If you use exactly the amount the chocolate chips call for in the recipe, that's what we would refer to as an ideal standard. Meaning, if we need 2 pounds of chocolate chips in a batch of cookies to reach our, to have the level of chocolate that we expect, that doesn't make any room for any waste. That's no waste. Every chocolate chip we buy is going to be utilized. Okay. Maybe a more realistic standard might assume that some of the chocolate chips that we buy are not going to get all the way into the cookies because they were mishandled, dropped, contaminated, maybe even eaten. Okay? It's probably not realistic that every single one of them is going to get there. We're going to need to have some level of waste so that we buy more than what we actually have to get into the cookies. Okay? If we insist on having ideal standards, meaning we insist on exactly what's on the recipe and no waste, that's going to be very frustrating for employees who are going to make mistakes no matter what we do, no matter how well trained they are, no matter how conscientious they are. They're going to feel like they can never reach that standard because there's no way that can happen. On the other hand, if we say, oh, okay, we're just going to have wasted chocolate chips and therefore we'll just plan 10% or 15% extra, that seems to be a little too generous in that now we have no incentive to be careful with the chocolate chips. All right, we have nothing that to drive us, and we'll always use less than what it says the standard is without even trying because the standard will be so loose, meaning it will have so much waste. So somewhere in between no waste and too much waste is a standard that will be challenging, that will push our employees to do their very best and to be conscientious and think it through and even be creative in how to make things work better without making it so difficult that they just give up and they don't care about meeting the standards. So what do we do once we have this standard cost? Okay, how do we utilize that as an evaluation tool after the fact? Okay, so this is how we look at the variances. Variances is the difference between what actually happened and what should have happened according to our standard costs or our flexible budget. So the total variance is the number of units made. So remember, it's based on what we actually made, not on what we were thinking we were going to make, but what we actually made times the standard cost per unit. And we compare that. That's a dash. That's a minus sign. Compare that. Take the difference between that and the actual cost of the direct materials. Okay? So that is your total variance. What's two things that could have caused this difference? We could have spent a different amount per unit. We should have bought the chocolate chips for more or less than what we planned. That's a price variance, right? It shows up in the price we pay for the chocolate chips compared to what we planned to pay. Or we used a different amount of materials than we planned, a quantity variance. We used more chocolate chips or less chocolate chips than what we should have according to the recipe, according to our standard. So we want to break that into two different variances. We want to look at the price variance separate from the quantity variance because they give us different pieces of information in terms of what we might do differently next month in terms of our planning, in terms of our actual execution. So we're going to have the materials price variance is calculated as it's given there in the slide, the actual cost per unit. So the actual cost per pound of chocolate chips times the actual number of units, pounds of chocolate chips purchased. So that's what we actually paid. You should have a bill for that, or at least a series of bills of what you bought during the month or accounting period in terms of the actual price you paid. Then we're going to take that number and we're going to subtract, okay, the standard cost per unit. What did we plan on spending on chocolate chips per pound times the actual? Notice that this actual number of units purchased is the same thing in both of these. So the only difference between this multiplication result and this multiplication result is this standard versus the actual. So another way to look at this is you could take the difference between the actual cost per unit and the standard cost per unit and multiply by the actual number of units purchased. Okay, that's another way of rearranging that. That will get you your materials price variance. That's how much we're different from what we planned on based solely on the price of chocolate chips. Materials quantity variance, it compares the amount of materials used with how much we should have used. So we need to know the actual quantity used minus the standard that should have been used. What should we have used to make the particular amount of product we made? Okay, not how much we should have made, how much we should have used to make some other quantity, but the actual production we had during the month or accounting period, and multiply by the standard price per unit. So, our example: standard price of $8 per gallon for whatever this material is, and that we use 2 gallons. So that the recipe calls for 2 gallons in each batch. So the cost, the standard cost is $16 per batch. We made 400 batches, okay, during the month. But it doesn't matter what we planned on making. We could have been 600, could have been 500, could have been 300, okay? But we made 400. So our flexible budget is going to be based around 400 batches. Now, actual materials, we purchased and used 920 gallons, and they cost $7.80 each gallon. So there's the amount we've actually paid, 920 times 780. Okay. Our price variance, calculated by taking the actual amount we bought times the standard, okay, and then doing the same thing and multiplying it by the actual. So this is what we thought we were going to spend on buying it. This is what we did. This is the difference. That's favorable because we spent less than planned. That's always how you determine whether a variance is favorable or unfavorable, is whether you spent less or more than you planned. So if you spent less, it's a favorable. If you spent more, then it is unfavorable. So we paid $7.80 when our plan was $8, so that's a favorable price variance. So we saved, you might say, $184 because of the lower price. Now, to do the quantity variance, okay, we take the 920 times $8, okay, and then we compare what we should have used. We should have used, we made 400 batches, and we should have used 2 gallons each. So we should have used 800 gallons, and they each should have cost us $8. Right? That's what we planned. So we use the cost of we used 920 gallons when we should have used 800. When we convert that to dollars, we take the 920 times $8, we get $73.60. We take our 800 gallons we should have used times $8, and that's $6,400. The difference is $960. Did we use more or less? We used more than we planned. We used 920 when we should have used 800. That means that our variance is 960, the difference, and that's unfavorable, just opposite of our price variance, which was favorable. This is referred to a quantity variance or a usage variance. Different books will use different terminology. Not really a big deal which one you choose to use, because we use more than one planned. Okay, so our flexible budget would have been $6,400. Actual amount spent was $71.76. That's the actual number of gallons times the actual price. So it was 776 unfavorable. That was because of 184 favorable price variance and an unfavorable usage variance. So we did a lot worse in the usage side than we saved in the price side. Together it's 776. So you see that comes out. There's two. You can put the two variances together, and then it will give you your total variance. Now, beware with raw materials or direct materials. The price variance plus the quantity variance equals a total variance only when the amount of materials bought and used are the same. And that's what this one said in our last slide, okay? Actual materials purchased and used with both 920. But what we realize with materials is that you don't have to use all that you purchase. You can use less and put the rest of it in inventory, or use more by using inventory left over from the month before. Okay? So you have to see if that's the case before you add them together. If they aren't the same, then don't add the price variance and quantity variance together. Just deal with them separately. Labor, moving on to direct labor. The nice thing is direct labor, there's no leftover from one accounting period to the next, so you don't have to worry about that last point like we do with materials. You have to buy and use the same amount each time. Okay, so that one complication is not an issue with the labor variances or direct labor variance. Okay, so again, the total variance is the number of units made times the standard labor cost per unit, and you compare that to the actual cost of direct labor. What did we pay our people? Okay, what could have happened? We could have two things go into that. Okay, we could have spent a different amount per hour, paid people more than we planned, or less than we planned, or probably more likely, use different number of hours than we planned. We're going to refer to if it has to do with how much we spent as a labor rate variance or a purchase variance. Okay, and if it is on the number of hours we use, we could call it either efficiency or a quantity variance. Again, we're not worried too much about the terminology. So here's the formula for the rate variance. We take the standard rate per hour times the actual number of hours used. So this is all of our people's hours added up, okay, and the standard rate per hour. And then we take the difference, the actual rate per hour times the actual number of hours used. Notice the actual number, just like before, and actual number of hours used, these are the same. So the only difference is standard and actual. So the difference between these two times the actual number of hours is the same. Okay. If we spent less per hour, then it's favorable, more unfavorable. Efficiency or quantity variance. Standard rate per hour times the standard number of hours that should have been used to make the product. Take the difference, standard rate per hour, notice that's the same, and the actual number of hours used. So really the differences between what we should have used and what we actually use in terms of hours. We use more hours, it's unfavorable. Use fewer hours, it is favorable. All right, that same thinking goes into our variable overhead variances. Okay, so again, we're not talking about fixed overhead where it just stays the same regardless of our volume. We're talking about variable overhead, the types of overhead that go up or down depending on the volume we're making. Okay, it could be, and these overhead costs often are broken into pools. So recall chapter 2 where we had activity-based costing, and we learned about breaking our overhead into multiple piles, if you will. Maybe maintenance pile, maybe shipping receiving pile. Each of those we would apply separately. So if you're using activity-based costing, now if you're using one plant-wide rate, which we also talked about in chapter 2, then you only do one set of variable overhead variances. But if you do multiple, then you're going to each do one, and you're going to have a set of variance for each cost pool. So we have to use the predetermined overhead rate. Okay, that's the cost per cost driver, cost per unit of cost driver, very much like we did the predetermined overhead. That's the standard cost for variable overhead. So we've just done the same thing and they called it a little different. So we take our flexible budget, a number of products we made times the count of the cost drivers that should have been used to make the product. So, for instance, if you were making 1,000 units, and they each are supposed to take 2 machine hours of this particular cost pool, okay, then that's your flexible budget times whatever a machine hour costs in terms of utilities, in terms of maintenance, all that good stuff to run that machine. So if we use a cost pool of maintenance and use the cost driver of machine hours to get a cost per machine hour of $60, so we had estimated the overhead, we had estimated the number of machine hours, we had determined the predetermined overhead rate. So the flexible budget production for 100 products where we should use 4 hours per product is 100 products times 4 times 60, right? Each hour for $24,000 of variable overhead from that cost pool for this particular accounting period. Okay? Assuming that we made 100 actual made. So we break it into its pieces. Okay, the total variance is fine, but we would like a little more information by breaking it into the rate variance, the number of machine hours actually used, times that predetermined overhead rate. Okay, compared to the actual cost for that cost pool for the accounting period. Okay, so if we used a higher predetermined overhead rate, then it is unfavorable. If it's lower, then it is favorable. So the efficiency or quantity variance, just like with labor, is the number of machine hours actually used times the predetermined overhead rate minus the number of machine hours we should have used. So we're comparing the number of machine hours to what we should have used times the predetermined overhead rate. Now, remember, we were supposed to use 2 hours per machine, per product for our machine hours. And being that they're machines, getting right on is probably more likely than with people. But there's still things that can happen. The machine can break down. The machine can have other problems that doesn't take exactly the same number of hours as we planned. Okay? If we use more than is planned, it's unfavorable. If we use less than is planned, it is favorable. Okay, and then our total variance is the rate plus the efficiency variance, difference between what we actually spent on maintenance and what the flexible budget for that cost pool, given that we were going to make 100 units. Now, That's all the variable costs, and that's probably where we spend most of our time with our variances, because that's where we have the greatest amount of control over our costs and determining what they are, and we expect to see them respond to these changes in volume. When we turn to fixed overhead, this is the costs in our overhead that are not expected to go up or down with volume. Then our approach is going to be slightly different, because we can't just use the same formulas as we did with the other three. The other three really have very much the same formulas. You just have to kind of adjust them just slightly as to how to think about them for direct materials, direct labor, and variable overhead. But the fixed overhead will feel different than all the other three. Okay? Actual fixed costs compared to our budget. So remember, our budget is not based on volume. It should be relatively pretty much the same regardless of our production. So if we're higher than we were budget, then it's unfavorable, and lower than it's favorable. So remember, if we're doing a flexible budget, the fixed costs are the same regardless of what the level of production is, right? So it doesn't really flex like the rest of the budget does. Then the second part of the variance that sometimes gives us a little hassle is we're going to compare the budgeted fixed overhead. That's the same thing as here. And what we applied. Applied overhead is the number of units actually made times the predetermined overhead rate. Okay? So remember, don't get the variable overhead in here, because we've already dealt with that. Just the fixed overhead. So we compare the budgeted fixed overhead with the applied, and the applied is what we actually made. So this is sometimes referred to the production or volume variance. It happens only because we made more units during the accounting period than we planned, than our static budget. So this is really not because of any performance other than sales and production as a whole. We made or sold more or less than what was part of our static budget. Some people would refer to this as kind of the uncontrollable part, because the person that is in charge of those costs probably doesn't have control over how much was sold or total production was for the accounting period. So it's outside of their control. Now, what do we do with this information we've now gathered? Well, it really doesn't do us any good if we don't actually look at these variances to see how much they are and what caused them. We're going to probably investigate, meaning ask questions, go talk to the people in charge of materials and the labor costs, all of these things. Investigate those that are significant. That may be 5%, it may be 10% of the total cost. So you would look at anything that was, if your chocolate chip planned cost was $80,000, you might look if your variance was greater than $8,000, or you might decide to investigate anything more than $4,000. That's 5%. Okay, but we need to remember to investigate favorable variances just as much as unfavorable. It may seem like, oh, well, great, favorable variances, that's exactly what we want, and we shouldn't need to go investigate. But as a couple of points there, favorable is not always, in our situation, it always means you spent less, but it doesn't always mean that that's a good thing. The term favorable maybe is used and maybe it's not the right term, okay, but it's been used for a long time. It's hard to change. But favorable may not be that great because we may have gotten a favorable price variance because we bought cheap products and reduced our quality. And we might be taking shortcuts on our labor, meaning people are not spending as much time as they should, and there could be an issue down the line because of those shortcuts. There may be safety issues. There may be quality issues. So we're going to investigate favorable variances as well as unfavorable variances.